first, I want to go to our post-game guest, Amir Adnani, who is founder of Uranium Energy Corp. And Gold Mining Inc. So let's bring Amir in because I want to ask him about the uranium market. Amir, thanks so much for joining us on the program today.
Yeah, it's great to be here.
Amir, I wanted to start off by picking your brain on how things are developing in this uranium space. I think it's fair to say that we've been in this prolonged bear market in uranium for at least the last half decade, with this oversupply pushing uranium prices to levels where it's completely uneconomical for many miners, like, for instance, Cameco shutting down the MacArthur River. Are we finally seeing conditions where the excess supply will deplete and these prices will begin to recover? What's your take on what's happened and how things are progressing?
Yeah, just for a bit of context for everyone listening, one of the unique characteristics of the uranium market is how the buyers of uranium, the utility companies that use uranium to generate electricity, they typically like to buy uranium under long-term contracts. And we're talking very long-term. Some of these contracts could be as much as 10 years. And so the contracts that were signed 5 years ago, 7 or 8 years ago at higher prices kept some of the producers continuing to produce uranium at these levels and, frankly, oversupplied the market. So one of the reasons why we did end up with an oversupplied market. And as these contracts start to roll off and expire, and then those producers are staring at this low uranium price of $25 per pound. And here they were all these years getting uranium at $45, $50 per pound under those long-term contracts. They're having to shut in production to help rebalance the market from being an oversupplied market to hopefully ultimately a supply deficit. So why we are fundamentally at an important point in the market today is that many of those long-term contracts, majority of them, have either expired or are expiring this year, next year. We are at the beginning of another major contracting cycle, but contracts cannot be signed at these very low uranium prices, where the uranium price is well below the marginal cost of production for most producers in the world. That's typically a setup for we've hit the bottom for any commodity. And now you see, like you mentioned, big producers shut down big mines. These are typically really important indicators that a commodity price is really bottoming. It's difficult to predict the exact timing of things will turn around, but ultimately I think that's what underpins the fundamental shift that we see in the market right now.
All right. And so what advice could you give our listeners when they're looking to invest into the uranium and uranium producing market?
The uranium market and mining uranium is one of the most highly regulated industries, more regulated than gold and copper mining, and equally regulated as what it takes to build a nuclear power plant. I mean, I can tell you from personal experience, I've been directly involved with permitting 3 different mines in the United States for uranium mines, and these can take anywhere from 5 to 7 years. I think one of the key areas to look at are whether projects that can be developed into a potential future uranium mine, whether they're permitted or not. I think that's such an important distinguishing feature of successful development in the uranium business is the ability to get permits, to get the necessary licenses to mine uranium. It's a very license-intensive business. And so you may have a lot of uranium in the ground, but again, if you're not in a jurisdiction, a country, a state, a province that has the necessary regulatory framework in place to be able to issue permits in a timely fashion, then I think that becomes an issue. So that could be advice. And, the other advice could be, frankly, patience, because uranium is definitely a nuclear industry. These are somewhat slow-moving sectors. And so the fundamentals may start to shape up, and we may be, and certainly are, at a positive turning point and a shift, as I mentioned, in the sector from a supply-demand point of view. This year is the first year in a long time that the demand for uranium at 190 million pounds per year outstrips what is projected to be production of uranium at about 140 million pounds per year. So that's a really nice setup, but that doesn't mean that you can expect to see a sharp increase in uranium prices immediately. But when it does start to move, the moves could be exciting. I mean, in 2006, you had the uranium price at roughly $20 per pound, similar setup as we have right now. And by summer of 2007, the price was as high as $140 per pound. So you also have the fact that once utilities really begin to contract, you must remember these nuclear power plants are big, multi-billion-dollar operations. And so the uranium is a very small percentage of their cost to operate. And when they need to have it, they must have it. There isn't a substitute for it. It's a small portion of the costs. And so, again, all of those are, points to keep in mind as if you're looking at investing in the sector.
Now, Amir, I wanted to move on and talk about gold. Now, what's your thinking here? Has this big breakout in gold that we've seen, is this the beginning of a new bull market? Is that finally that turning point here?
It really depends on what your expectation is or what your thinking is around the forces that could be driving the gold price. I think for a long time, there's been a singular thinking around what drives the gold price, and it's the relationship it has to the U.S. dollar and the inverse relationship it has to the U.S. dollar and also the 10-year treasury. I think while that is true, we're in an environment right now where we may end up seeing a rising U.S. dollar along the side of a rising gold price. And that really, I think, speaks to the fact that with the incredibly, and this is hard for me to understand, but this incredible phenomena, which is growing, it seems, at a monthly basis of negative interest rates. People sometimes say, oh, well, negative interest rates have always been around. Japan's always had them. But we've never had it in the size, order, and magnitude that exists today, close to 17 or 18 trillion dollars of negative yielding interest rate throughout the world and the developed world, places like Germany that has gone entirely negative now. This is an environment that I think suggests the groundwork is laid quite sufficiently for stronger gold prices for a long period to come and rising gold prices along the side of strong-ish U.S. dollar. Now, having said that, just about every central bank on the planet, including our own Fed, is going to be easing. And so for the Fed, it's going to be, I think, very difficult. And for the U.S. economy, it's going to be very difficult to have a very strong U.S. dollar when every other currency is heading south and easing is taking place just about everywhere. So it seems like for fiat currencies, it's a race to the bottom, and it's a race for every major central bank to try to basically devalue almost this currency. In this environment and the record level of negative yielding interest rate, gold should be the winning place and a safe place, and a place not only to preserve and protect wealth, but to also create new wealth. You've seen big banks like Citigroup come out and project $2,000 gold price in the next 6 to 12 months. And it's not some, the CNBC commentators would typically be calling gold the barbaric relic or whatever they call it. That's no longer the case. And I think you're seeing that consensus start to develop as why it's almost imperative to be exposed to gold, holding gold, physical equities, whatever the form is. And I feel very confident in that.
Now, you're going to be joining me at the Silver and Gold Summit as well, with speakers like Rick Rule and Marin Katusa are all going to be out there. Now, the Silver and Gold Summit is at the end of the month. What are you going to be speaking about or discussing during the show there?
One of the topics I'm going to be talking about, and I'll be talking about what I typically characterize as the two yellow metals. And so it's gold and uranium are the two yellow metals. And, we just touched base on both of those. But I'm very intrigued, have been for many years now, with the royalty business model. It's been a phenomenal way for precious metal focused royalty and streaming companies that basically advance capital to a developing or up and coming producer to in exchange for a future royalty on that commodity that they're going to mine, and build a business around that. Companies like Franco-Nevada have become significant sort of multi-billion-dollar players in the gold space. And I'm very interested to implement this business model in the uranium space. So I'll be talking about a company called Uranium Royalty that I'm the chairman of, and this company's business plan on how to kind of implement the royalty model in the uranium sector. And I'll also be talking about what President Trump has been doing in terms of looking at and mandating that a White House nuclear fuel working group be created, because there's a national security issue around the shortage of uranium in the U.S. U.S. is importing practically all of its uranium requirements from foreign sources, mainly Russia. And this is something that has geopolitical implications. And there might be definitely news and developments around it as well by the time we get to San Francisco. So want to talk about things that are pressing and sort of around us, and I think people are going to want to hear about. And so those would be just a couple of topics that I'll be touching base on.
Well, that's great. And can you please share with our listeners where they can learn more about you and your companies?
www.uraniumenergy.com and www.goldmining.com.
All right. Well, thank you for joining us, and I look forward to seeing you in a couple of weeks out at the show.
Looking forward to it as well.
Thank you.